Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're counting down to the next VRIC, January 21st and 22nd, 2024. Tickets are in the description below. And today's guest is a macro economist, an expert on business cycles, and the founder of the Zeberg Report. It's Henrik Zeberg. Great to have you on the show.
Thank you for having me on, Jesse.
Well, we're honored to have you on. And I want to start with the prediction you're making in terms of a continued blow off top in the stock market here in 2023, potentially into early next year. Not a lot of people are making this call. David Hunter is somebody else that I also know is echoing the same sentiment. And you mentioned recently that it is the understanding of business cycles that has helped lead you to this conclusion. So can you talk about that for us, both the prediction you have for the blow off top and how business cycles have helped you understand this?
Yeah, absolutely. So let me start with business cycles, because as I also put in a tweet just the other day, I think business cycles is something that is very, very much misunderstood by a lot of analysts. I have a way of looking at business cycles through the leading, lagging, coincident indicators that you get from the conference board, and I've developed a model together with Swissblock, which is a Swiss hedge fund, a model of how to simply, gauge where is the economy at, where is it in terms of what we see now, looking, ahead, and also looking right now, what we see right now, but also what is, what should be coming, or what did we see, earlier on. So if you look at these dimensions, these perspectives, you will actually see that the leading indicators, which are the ones that the conference board is simply using, you would see that they have been plummeting. They were plummeting already in Q4 of 22, and they have, with that crash, actually already put in the signal that we have now that we're going to get a recession. So the recession is coming, no matter what you hear, and this is what we would already see last year in Q4, but at that point, and also still, we see that the coincident indicator, which is really looking out the side windows, are still telling us that we are not there yet, and we haven't been, even close to that. And when people were calling for a recession in Q4 last year, I was, nothing of that indication. You had, all the indicators in the coincident level, which are the ones that tell us where is the economy at the current state. Simply, we're not indicating that. So when you looked at that and you saw the inflation spike we have had, which normally, throughout history have always brought equities down, you kind of made up and say, well, put it together and said, well, it's inflation spike. It's going to come under control again because it was due to supply and demand issues or challenges due to the stimulus coming out of COVID. And this is going to, be reversed. And that's why I also call for a top in inflation, and we should see that coming down really strongly. A view that was, highly disliked, I would call it, 9 months ago. But that's what we see. And when you see inflation coming down strongly like that, and the economy does not roll into a recession, which we can see on the coincident indicators, well, then you have the perfect setup for a very strong market in equity market. And that's what we have seen. So for now, you are in an economy that is in a Goldilocks zone. Inflation is coming down. People are now starting to understand that it didn't roll into a recession. The economy didn't do that at this point. And for a certain amount of time into the future, we're going to see that continue until the deterioration that we now have seen in the leading indicators are going to come through into the real economy. But that can take, it can take even up to a year from here. So I am cautiously saying until Q4 of this year with the stock market, but it could also be, as I said, Q1, potentially even Q2. But Q4 and Q1 is my prediction for now.
And you mentioned that a recession is baked in. It is ultimately, eventually going to come. How do you think that will be coincided with a large bear market and a large correction in the broader market? And how deep and severe do you think the recession could be? And do you think a correction in the broad market could be when the recession finally does hit?
But it's going to be a very, very deep and tough recession, because you could say the free lunch is over. So in 2008, you could just go out and you can print money, and then you've got I would call it the bounce we have had ever since. I know it's 15 years of bounce, but anyway, But if you had that prolonged period of time where you've seen European equities, for instance, almost go sideways. Of course, they're still moving up, but they have, they dropped and then they went sideways. So if you look in a world market perspectives, also emerging market, you'll actually see that what we have had ever since 2008 being something of a sideways move. Only the U.S. equities have been moving up a lot higher. But as I said, the free lunch is over, and this time around, I think they're going to do the same. Thinking that they can do the same thing over again, simply just printing a lot of money and bringing up the balance sheet of the Fed. They will do that when the recession finally sets in and deflation comes back, which is what I predict as well. And then they are going to cause a stagflationary period as well. So what we're going to get is going to get a deflationary fallout first. They're going to get in as they did last time, not knowing that this time around is completely different. And then you're going to set off a stagflationary period. And that's why you're going to have a very, very difficult, setup in front of us, because we're going to have the blow off top, which is now developing. We see, a lot of equities up, indices up quite a lot. And then we see we're going to see first the deflationary bust, and then later on a stagflationary bust, and that's going to be really devastating for a lot of investors.
And we're seeing a small handful of equities that are holding up these indices as well, the S&P 500 and the NASDAQ. It's a handful of these blue chip tech stocks. We've seen Apple reach all-time highs, NVIDIA ripping. Is this part of the danger that this bull market is kind of a house of cards in that sense, that such a small number of equities are kind of creating this blow off top?
That's a normal cycle. I mean, this is where you kind of you're afraid of getting back into the water, so you kind of tiptoe in and you just test it out with the big toe, and the one thing you say, okay, I can easily pull that out again, and I'm not too scared of testing out and investing in Apple. And then you try out some others, and then something of AI comes up, and slowly you'll see that it spreads into other equities as well. And at some point, people are just going to go full FOMO, and it's just going to blow into and I think this is going to be, I don't know if it's called the worst FOMO or the largest FOMO we ever seen before this is over, because people now think, oh, we actually the Fed actually did construct a soft landing, and now we're just going to go into the stratosphere in terms of equity price, and people just keep buying up, and the Fed got our back and whatever they're going to say. But the thing is, the business cycle, yes, it's baked in already. It's in the business cycle. You've seen the deterioration, and the deterioration is really coming from inflation causing higher rates, and the higher rates are still really high. And this is causing a lot of havoc amongst the consumers, because they will, everybody will then hold back on their consumption, and that's where you start to get that feedback loop, which is slowly eating itself into the economy. And then people will start to be laid off at some point, and then you're going to see the cycle turn, really. So at this point here, it's taken a while, because you've had companies that have earned a lot of money over the last, ever since COVID, because they created this artificial demand. Everybody was building up capacity, and then now they start to see, okay, maybe we're not going to the demand is not going to come to fruition, but let's hold on just for a little while. We did earn a lot of money last year, so let's not start firing people. And then, as it actually deteriorates even further, we're getting further down the road, then, it will roll over. And that's what the leading indicators tells us. And the coincident indicators have started to deteriorate also somewhat. Initial claims are still, very, very low. We see also the non-farm payrolls, good numbers coming out still, and compared in historical perspective, really high. So it doesn't just roll over overnight. We need to see the NFPs coming down to, let's say, 50, 100,000, be there for a little while, and then we're going to see the drop below, and then we're going to see the acceleration. For now, the economy is good. Open positions are still very high compared to the number of unemployed people. So everything is actually based on a strong labor market at this point here. And forget about the Fed and whatever they do right at this point here, because we already have seen the rate hikes which have been damaging to the economy. And as the rate starts to roll over now, because the lagging indicators are starting to also see that, or to get to turn, like what we see with the coincident, well, then you're going to get rate declines. So rates are going to come down rather strongly at some point, which at first will be supportive of the economy. So it's going to be really difficult, because I think with the extreme spike we have seen in the business cycle, which was created by this artificial demand, that is going to create an artificial also contraction of the demand also, because you don't go and buy that extra car one more time or whatever it was. It's now being pulled back, that kind of demand. That's what was going to be really devastating for the economy down the road.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
I want to get your thoughts on gold here, because I've seen a couple of recent interviews where you discussed gold, and in the short term, at least, you seem to be bearish. So I'd like to get your view on where you see the gold price going, how it's performed here in 2023, and when we do see a recession and a market crash, do you think we will also see a rise in the price of gold eventually? Will it fall along with everything else and then eventually rise? I'd like to get your thoughts there.
No, but as I described, when you have deflation, gold is not a good hedge. I mean, gold has a role to deliver liquidity when none can be found, in the market. That's why you want to hold gold, because you can always sell it off and you can get liquidity, which is dollars, to pay off whatever you need to pay off. And that's why gold is obviously always a good thing, good hedge for that. But you do not want to invest into it in the moment where you get the deflation, because when deflation sets in, liquidity will be needed in the market. And that's what you saw, actually, if you look back in time and saw the period from March of 2008 until September of 2008, you actually had that strong decline in gold. I think it was 33% or something. And it makes sense. You had a recession, and you had liquidity was scarce. So people that had gold, were needed to sell off gold to actually pay whatever kind of debt they had. So we're gonna see that period again. I just think this time is going to be a little extra difficult or challenging for gold, but it will be a tremendous opportunity. So the opportunity lies there within gold to actually start buying into it. And when we get down to the level, so I have famously and infamously called for 800 to 900 on gold. I think that can still be the case, or it may bottom out at around 1200. But it doesn't matter. I mean, this is I need to see that decline, because that will be at the same time we see the rather devastating deflationary bust that I see, which seems to be setting up now. You got the huge amount of capacity out there in confidence has been building up. The demand is pulling back, and if that starts to come to fruition, well, then we're going to see that negative spiral in terms of deflationary bust coming out, and that will not be good for gold. So I am a gold. You can build BOC, but I will be investing into gold, heavily. When we get to that point, we're just not there yet, and everybody has been calling for a above 3,000 price for the last many years, and I've said no, it's not that. We're not at that point yet. I find no troubles in forecasting, let's say 15,000 on gold, but not until before we have seen that correction, which is still needed. So 800-900, or potentially bottoming out at 1,200.
I wonder what your thoughts are on the announcement of this potential BRICS currency. We actually saw a tweet recently, I believe it was from the Russian embassy in Kenya. This was the first time that there'd actually been put in writing that there will be a gold-backed BRICS currency. Now, it's Twitter. I have no idea how legitimate that tweet actually is, but the BRICS are having a meeting in South Africa. I believe it's going to be in August, where rumors are that they're going to officially announce this new BRICS currency as a unit of international trade. And if it is backed by gold, do you think that could change the gold thesis that you have somewhat and perhaps be a tailwind for gold? Do you think this currency is actually going to come to fruition? What are your thoughts there?
Well, first, we need to see if that's really the case. But definitely, I mean, if it is a stated policy from, or more or less stated from the Chinese administration, that obviously the U.S. and also from the Russian, that the U.S. Hegemony or the U.S. dollar hegemony is a problem, and everybody knows that if you want to challenge the Western world, you need to challenge the U.S. dollar hegemony, and if you don't, well, then you no chance that you'll be able to compete with that. So of course this is something that is on the table for the BRICS countries, for China and for Russia in particular. I just don't think that the rest of the world is just going to sit idle by and look at that and then say, okay, we're just going to let the US dollar hegemony crash, and put then the real power of everything actually into the hands of China and Russia. So there will be, of course, an answer to that if that happens. Of course, that goes without saying. Of course, these challenges going to come. We're going to see those come up, and it makes absolutely sense from a political perspective from China and Russia to challenge this. Whether it's going to challenge my setup in terms of gold. Again, I've also said that there is a potential setup where I could see gold could reach an all-time high before we actually see a decline in it. I will still say the structural setup that I see in gold is bearish for now, very bearish in fact, and we should see that decline. But if that happens, of course, that is something that will have an impact on gold, because we need sound money again, and that by the end of what I call the contractive winter, we are going to see sound money coming back, which means in my world that we're going to see a gold-backed world currency coming in at some point. I think the BRICS setup is going to be contested by what we see in the Western world, and I think the Western world will prevail on this. But also by putting up something of a gold-backed unit at some point. May not be right here, right now, and I still see a lot of strength in the dollar. Not strength right now. My dollar outlook is really that we're going to see these levels here and then dropping down to around 90, 91, 92-ish on the DXY. But then before we actually see the top in the dollar, we should reach 120 because the current decline we've seen since September of last year is just a correction in the bull market. So I see the DXY in 120 at some point, which will be very deflationary for the world.
Very interesting analysis. And the fact that you see some sort of gold-backed currency coming would kind of coincide with all the central banks we're seeing accumulate gold, both BRICS countries and non-BRICS countries. So that will definitely be something to watch. What about Bitcoin in this situation? I believe you're bullish on Bitcoin, at least based on some of the tweets I've seen you make. Do you think Bitcoin could ever be that sound form of money, seeing as it has a built-in scarcity, it is decentralized and has no government controlling it? Do you think that's a possibility? Do you think governments will be threatened enough to kind of implement policies that make it very difficult to use Bitcoin? What are your thoughts there?
Bitcoin will never get that role. I mean, that's a misunderstanding. I mean, everybody who has this DeFi kind of understanding of things doesn't understand what is really ruling the world here. And the thing is that I mean, the Western world will not leave it up to chance, in terms of how geopolitical situation, and so the financing of the deficit in the US right now relies on that US dollar hegemony. Of course it will be challenged, but why would you then leave it up to Bitcoin? So that will be challenged, and it will not be able to revolutionize the world. And this is something that will challenge the US dollar hegemony. I think that is very misunderstood. What I see is that Bitcoin and crypto in general, but Bitcoin most, maybe as the leading cryptocurrency, crypto I would call, has a role and is a gauge for liquidity. And I see liquidity is coming back into the market now. We start to see that the central banks of the world are starting to become more fearful of that. Actually, inflation may not be so much of a problem, and actually we could see something different. And you see China already doing some easing there, and that starts to show, and that will be what drives Bitcoin up again, as I see it, rates coming down, the dollar declining, which is what I expect into the last part of this year. and maybe an earlier next year also, and we will have a tremendous move there. And if you look back in time, you can see when the dollar has actually come below 100 on the Dixie, or even 95, you start to see the Bitcoin and cryptos, moving up. So my prediction here is that when we see the decline in the dollar coming down to around 95, 90-ish, or something like that, you'll start to see the real takeoff in Bitcoin and crypto. But 99% of crypto is going to be wiped out when we see the deflationary bust. And we have never seen a recession, a real recession, not just a short one we had in during Corona, that while we have had crypto. So how crypto, which is very, very liquidity dependent, going to react in a world where liquidity will be very scarce? I predict that they're going to crash. And the crash we saw here in 21, 22 is not going to be anything, it's not going to be, it's going to just be the beginning of what we could see in some cryptos. You're going to see blow-offs in a lot of these crypto coins. Bitcoin, how will that react? I think we're going to see a very, very big bear market for a long time. I think it will survive, and it will have a role again and again, where when liquidity goes up, you will see like Bitcoin can also do well, but it will never get the role of just the geopolitical policies are simply too important for the Western world to say, okay, we just leave it up to chance how we finance things. That's not going to happen.
Yeah, that makes a lot of sense. I want to end on where you see central bank policy headed. You touched on the Fed and that you see rates coming down. Obviously, Powell has maintained somewhat of a hawkish stance, claiming that we might see a few more rate hikes, maybe 25 basis points this year and into next. And, they still claim to have the target of 2% inflation. Do you see inflation getting back down to 2%? Do you see them sticking to this kind of hawkish stance? Do you see them being forced to reverse course? What's your view?
So inflation is definitely coming down. And this is where people need to understand that this has nothing to do with Powell or the Fed. It has to do with the business cycle again. So you have the leading indicators, which have been crashing. Now we're expecting that crash to also come into the coincident indicators, which are the employment, which is GDP, and which will also be other areas of the economy. And then you're going to see it in rates. And this is what people miss out on. They do not understand that the rates, first of all, are not set by the Fed. The Fed actually follows the 2-year more or less. So where you see the 2-year yield goes, it's a US 2-year yield. You see the Fed also kind of go, right? So it's led by that. And the yields are coming down when demand is, when the economy starts to roll over, when employment gets lower, investment gets lower, then you'll see the demand for capital actually getting lower. And the demand for capital is what drives market rates. And we are now at the top of that. And everybody's talking about how weak the economy is, but they're still saying, oh, but Powell is going to go higher for longer, stay higher for longer. It doesn't add up. What I think we're going to see is that Powell wants to make sure that we get a soft landing. That's what he wants, and he doesn't want to crash the stock market, as we also hear. So he wants to maintain, a level where there is a trust in what he does, and he knows that he needed to raise rates as market rates were soaring before he ever got to do anything. So he needed to follow that, and he's simply been lacking that for a little while. And now we need to see that top in the 10-year and the 2-year. I think we're there, and that's also what the business cycle tells us. But our indicators are just at the topping point here, and seems to start rolling over. We start seeing some negative prints to the components of the lagging indicators. So rates are going to come down, and they will come down because the economy is going to crash into a recession, and in a recession you're going to see rates coming down to new levels. Inflation will reach new levels. You're going to have a bigger deflationary bust than you had during the financial crisis. And that's also why I don't want to hold gold. Not now. I want to hold it when they get back into the game and they say, okay, now we are all in and we do whatever, especially if they are so clever to unleash a stagflationary period, which I think they will. And that's the time you want to hold gold.
Well, thank you so much for joining us today, Henrik. For those who want to learn more, could you tell us about the Zeberg Report and where people can find that?
Yeah, so we got the Zeberg Report, which is our channel. We got the website. We got the Twitter profile, Twitter link also, where you will find me on the Zeberg Report talking about the economy on a weekly basis. It's subscribers. So I basically sit down with the indicators of the business cycle, explain where I see we're at, and also based on Elliott Wade perspective, understanding the perspectives in terms of how far can we actually go in these markets. And then so I talk about equities and the commodities and the rates, everything, and get a full picture of the economy and what the state is. So that you can find on the ZebergReport.com.
Great. Well, I'll put links to that and the Twitter as well in the description below for people who want to check that out. Thank you once again, Henrik, for coming on and sharing your knowledge with our audience.
Thank you, Jesse, for having me on. Thanks.